Sen Gupta, MD and CEO at Bandhan Bank, to talk about their numbers. Partha, good to be having you on the show today. Your margins continue to shrink. Is it only about loan mix, and will it continue to shrink further? And do you sense there could be any support that you could have perhaps, from cost of deposits falling?
So this has been one of the definitely a challenging quarters for Bandhan Bank. As you are aware that we are making a transition since November 2024, transition towards a more secular lending across all assets rather than focusing only on microfinance. So as we started this transition and moving towards more secured books, which has definitely a much lesser margin compared to the microfinance books, but we were not expecting the upfront rate cuts that would happen. So the effect of the upfront rate cuts have been passed to all our eligible customers from the first day of this quarter, while our cost of funds, which got moderated in the month of May, the first moderation has taken place. So that is yet to take an effect.
Mr. Sen Gupta, what should be steady state margins be, and what's the aspirational target for you?
No, so we have already made a strategy at the beginning of the year. We will try to contain with the strategy. Right now, I don't remember the exact points for the day, but I can say that definitely Q3 we will see the improvement in margins, and Q4 there will be a substantial improvement because a large part of the cost of funds will come in the Q4.
Right. And what about the book quality? Because your credit costs remain elevated. Do you have any visibility on Q3 onwards?
So the credit cost, sequentially it has marginally improved, not to that extent. So we have kept a guidance of credit cost for the EV or the microfinance segment at 2.5 for 2026-27. We are keeping that guidance. We have also kept a guidance of 1.8% for the bank as a whole for 2026-27. Currently, we are around 3.2. So we are not changing the guidance till now. We are hopeful that both in the EV segment where the NPAs are rising, it will be moderated, and definitely the slippages will come down. And so provisions requirement will be this. And in the secured books where we are almost in line with the industry trend with all the banks, the requirement of provisions will be much lesser. So keeping that, the guidance of 2.5% in the micro segment and 1.8% for the bank as a whole at the end of 26-27, we are keeping it unchanged.
Right. And where should the GNPA stop out at? Any level that you may have at in your mind?
So if you look at my portfolio, the GNP is again mainly coming from the EV book or the microfinance sector. In respect of the other assets, whether it is a wholesale banking, it is much lesser than 1%. In the housing loan, it is around 2.3, 2.4%. In retail also, it is at around 1%. So in all other segments, my NPAs are contained. The only thing where really the delinquencies are happening in the EB segments. So as I've told you just now, that the SMA-1 and SMA-2 portfolio of this particular segment is showing a declining trend. So hopefully going forward, the NPA levels would substantially come down. So we are targeting at around 4.5. We're currently at around 5. So by Q3, we expect to achieve around 4.5 and further improvement by Q4.
Right. And your treasury book, that's caused a sharp contraction in your other income as well. When is the rebound expected? Do you have full year visibility?
So other income has shrinked primarily on treasury income. So if you have noticed that Q1 had been a good year for treasury, the Q1, and where we have booked almost 185 crores through trades. But that income is not available in Q2 because of the elevated interest rates. And so going forward also, we are looking to increase our other income. So it maybe the treasury will contribute much more than what is there. So we have also revisited our service charges. So that will also come into effect. Maybe Q4 onwards, you will see an elevated other income. in the bank's portfolio.
Right. And what about growth? What's the progress and visibility for FY26?
So in the deposits front, you have already seen that we have grown by 11%, which is more than the industry level growth. In the advances front, we have grown by 7%, but this comprises two segments. In the non-EV book or the non-micro book, we have grown by almost 24%, which is almost much better even than the industrial growth. But in the EV book, we have declined by 13%. So as I've said just now, that seeing the improvement that is gradually coming in the EV segment, probably this growth will take place. And with this, we may grow at around 10 to 11%, both in deposits and advances.
Right. And what about the portfolio look as you rebuild? And how would the 3-year outlook on book size and mix be like?
So portfolio, as I told you, that we are in the Bandhan 2, phase 2, what we are saying Bandhan 2. So our aim is to grow secularly in all segments. So whether it is microfinance and whether it is housing, whether it is retail, whether it is wholesale banking. So the portfolio will have a mix. Definitely the EV book, which has now shrunk to 37% from what was a year ago was 47%. So that may stay at that level, or a little bit it may shrink further. And our secured book, and that will increase. So while our aim is that while we will grow moderately in the EV segment, we will grow at a much faster rate in the other segments, that is in the wholesale banking, housing and retail.
Right. Partha, great to be speaking with you. Thank you so much for your time today.